Hello and welcome, dear investors, to our dividend graveyard. That means that nobody is perfect, neither me nor Chad, and we did some mistakes, some very bad mistakes. Some years ago, we still do mistakes, but we made some mistakes which were maybe avoidable. And hello, Chad in Seattle.
Hello.
Hi. Chad and I, we chose some positions, some stocks we bought, and where we literally completely failed. So it cost me several thousand euro, and Chad, for you, I guess several thousand US dollars. I'm right.
Yes. Oh, yes, at
Mhm,
least.
mhm. And I think we will present these and we will show you what happened and what we learned from that. Maybe we made some common mistakes. And I'm nearly sure that some of you who are watching this already made the same mistakes. And it's our objective to help you a little bit getting better investors. I'm right with that, Chad?
Let's do it. The main thing for me is strategy changes and learning. The biggest lesson that I learned was talking about was basically what strategy should I use and why some strategies work and some do not. One of the reasons why I started the Total Growth Investing channel was because I saw so many people coming into the space, coming into the markets, having certain assumptions, thinking that dividend yield is the end all and be all, that they wanted to build a revenue and they could do it really, really quickly. And when Torsten suggested this as a topic for a live stream, I jumped on it because that's the attitude that I had 10 years ago. So I want to show what that meant for my portfolio and how far back it threw me when things fell apart.
Yeah.
So
Okay. For me, the same. I'm also going to look back 10 years ago till the financial crisis,
yeah.
even a little bit before. So you present your stocks first?
Okay. So what I did is this is a list of some of the winners and some of the losers that I had. And I'll go into detail on a couple of these. Torsten was nice enough to add two of them to his site, to the dividendstocks.cash, so we could see what I should have seen. Those two in particular, AG&C and ARR. But the first thing that I want to talk about are these two, the absolute junk stocks. MRRL and MORL were mortgage REITs that I first noticed back in 2010 with MORL because it had a 15% dividend yield. And I was in the beginning of a dividend hunt, looking for stocks that would build a revenue stream that would basically pay my bills for the long term. And I wasn't noticing anything else. I was relatively new in the markets. I had not done much, and so I thought dividend yield was the end all and be all of everything that I needed to know. And so I put in about 3,200 into MORL. And at the beginning of the COVID-19 crash in February, they dropped below their threshold for complete cash out, and they cashed out. And my return on that $3,200 was $120. 96.29% loss from that. MRRL was another one in the same family, doing basically the same thing. They had the same portfolio, and it also crashed almost as
Mhm.
badly. So I learned a really hard lesson, and that's one of the reasons why I created the Total Growth Investing channel, is because I didn't want anybody else to have to go through that, or I wanted to try and prevent people from going through that. Another one that I lost a lot on was IVR, which is still out there. We can bring it up on Seeking Alpha, and we can look at their momentum going back 10 years, and they have not recovered from the COVID-19 crash. So anybody who suggests this in the groups that I moderate, I jump in and say, please pay attention to what you're getting. Please know what you're getting into. Because over the last 10 years, let's look at total return. Over the last 10 years, you, even with the dividends, you will have lost almost 30%.
You just mentioned 3 stocks, and all 3 stocks were mortgage REITs, right?
Yes. I'm pretty sure this is. Let me quickly jump to financials.
The name already implies that Mortgage Capital Incorporated.
Exactly. So mortgage REITs and financials, and they've been around since 2008. And let me show you why they are attractive. Yeah, this is what got my attention. And this is what got my attention because they've quote unquote been paying relatively steady. This is what I did not pay attention to, the dividend growth. Let's bring up the other two that I wanted to show, which are these two, AG&C and ARR. Let's bring up ARR first. Armor Residential REIT. It's yet another mortgage REIT. And we are on dividend growth, minus 40%. They have cut and cut and cut and cut. And you can see that in the history going all the way back. And it's like, my thought was that because the dividend yield was steady, it was a good stock. But I wasn't paying attention to the price of the stock. Let's go back 10 years, and it's just a downward slope the entire time. And if you look at total return over 10 years, you're losing money almost every single year. And again, here's the COVID crash, and they have not recovered in any way, shape, or form. So ARR, let's actually look at the fundamentals of that the same way that we do with all of our really good stocks on dividendstocks.cash. And here is when they got my attention. They were doing really well. Operating cash flow was pretty decently high, and they started to slip, but I was distracted by the dividend yield. Let's look at dividend yields over time. Here is the percentages. So right in the time that I bought them, 2012, 2013, they were floating between 15 and 18%. And it's like, yeah, that's what you seem to want if you're trying to build a revenue stream, right? And it stayed steady. The yield itself stayed steady. I wasn't paying attention to the actual number itself.
Also, chat, pay attention to the present or to today. You see that the dividend yield spiked up. The dividend yield on paper, just the current dividend yield. How many percent it is? I can't read it. It's too small for me.
23.76.
Yeah, exactly. So what happened? I call this the dividend trap. What happened is bad news came out. Probably management already announced the dividend cut, but on paper, the dividend is still there, at least not the forward dividend, but the dividend based on the latest real data. And that's what most financial websites present. And then you really get a problem. And
I like the alarm in the background.
Alarm. Yeah, wait, I'm closing the door.
No, it's fine because you see something like this, and somebody needs to flag an alarm, and I wasn't paying attention. But look at this. Look at this downward slope of the dividend and the downward slope of the price, and this was distracting enough to make me ignore it. And it's like, ouch.
I have one question, Chet. Because all stocks so far you presented, now it's already 4, have been mortgage REITs so far. So did the didn't you obviously, or maybe you also didn't pay attention to the diversification of your portfolio?
Right. I was
Okay.
only focused on dividend yield. Diversification didn't mean anything to me because I was building such a good income. And let me quickly show you the revenue stream that I was getting. Okay. This is the revenue stream that I was building. All right. Blue down here is the monthly total. Green is the monthly average. This is quarterly. This is annual. This is when I started my dividend hunt. So I was building this average annual income and revenue stream really fast. It slowed down a little bit because we had some issues and I couldn't make as much of a deposit each month. But then it started up again, and I had built this revenue stream all the way up to 3,164 or so every single year. Okay, this was at the beginning of the COVID crash. This is what my quote unquote revenue was going to be, and it had been going up for 10 years. This is why I was so distracted, is because I was only looking at the yield. I was only looking at the actual revenue that I was getting. And then MORL and MRRL cashed out, and all of the other mortgage REITs that I was invested in crashed. And I had to find a better way. I had to look again and learn a little bit more and figure out what I had done wrong. And you can see the orange line here is actual. So my dividend annual revenue has crashed back down. Down here, you can see that, just over the last 2 years, you can see it's crashed, not quite to zero, but my goal with total growth investing is to build this back up to what it was. And I expect it to take a little while, but I'm much more secure in what I'm investing in now.
And did you sell these stocks you just presented, which performed badly? You sold them.
Yes. And let me show you why. Let me jump over to my total growth investing ranking list. And most of the stocks that did not do well when I started building this list, they kept falling down further and further below everything else that I was adding. And here are the junk stocks that I still have in residual in some portfolios or this or that or whatever. But I'm getting rid of them as fast as I can. But you can see highlighted in orange the ones that I wish I had not invested in, because they're all the way down at, between 648 and 673 in the ranking score. And the ones that I'm investing in now are my top stocks up here, higher than 100, and they're doing much, much better. Let me highlight some of my real successes. And I will say that I wasn't investing over the last 20 years only in junk stocks. One of the really good ones was Microsoft, which I had put $650 in maybe 10 or 15 years ago now. And those stocks are now worth $6,400 for an 884% increase. Comcast actually was a spinoff of AT&T a long time ago, and they did some mergers with Time Warner Cable and et cetera, but I had originally put $109 into the value that is currently 717, and I got that from E-Trade because of the mergers. They keep track of all the math. AMD was another big success. I had only put $97 into it, and right now it's $569. Texas Instruments is the first stock that I ever bought, and it is currently at $12.81 from 224 put in, or 225. So these are the successes that I've had. And these are the ones that I'm building thanks to the new strategy that I put together.
Yeah, that sounds nice. And your key takeaway: find your strategy and find your reliable source of information, and then.
Oh yeah. Really quick before we really get to the bottom line, let's bring up the other one that AGNC investment. This is that other mortgage REIT that I lost so much from, and you can see why. Here's the earnings per share. It literally dropped below zero, adjusted, but the operating cash flow has been going down. The stock price has been going down. Let's remove the shades and just look at, oh man, I gotta remove this too. Otherwise it's just, so it's been going down since 2012, and the dividend has been dropping since the whole time, actually. Let's go to Dividend Turbo again and look at the yield. It's been floating between 10 and up to 22.5%. And this is what was distracting me, and it was distracting me from this. So lessons learned. Compare that with some of my favorite stocks right now. My standard is MasterCard. The dividend floats between 0.8 and 0.2. That's current yield, but current yield is not the end all and be all, because the valuation's been going up like crazy. So, or Microsoft, which is the one that we already saw, Microsoft. Same thing. The value has been going up. The dividends have been going up. It's the complete opposite of what I was doing. So lessons learned, you gotta focus on the fundamentals. You gotta actually know what you're buying, and avoid the dividend traps. Current yield is a trap, whether you're looking for the super high values or you're avoiding the super low values, because what matters is the dividend growth, the yield on cost, and the price difference. How fast is it increasing in value?
Exactly. And the underlying metrics. I always tell people which are financing, especially cash flows, which are financing the dividends. Without that, nothing happens in your portfolio. Okay.
So what lessons have you learned over that period?
Hard lessons. Let's enter the time machine and go back about 10 years when I was still a young boy. Exactly. Thanks, Chad. Maybe we even enlarge this a little bit further. So what I show you here is on a blog which is still live from me, my first financial blog. Let's go back to the financial crisis. And I'm investing already for about 20 years. But already when I was still a student and hadn't very much money to spend, luckily, I must say today, because I think my investments wouldn't have been too good. Anyway, I was, like Chad, someone focused very much on dividends. People who know me right now maybe can't imagine, but 10 years ago I was, or 10, 11 years ago exactly. And when you look at these stocks, and this is my portfolio on the end of March 2009, during the height of the financial crisis, and then you see stocks like Aeon, General Electric, Hennes and Mauritz, Kraft Foods, Telefonica, Total, or Total, if maybe in English, Unilever, 3M, and you see that these are all dividend-paying stocks. And as already said, and it was also, I was not chasing high dividend yields, and I already thought I'm a little bit of an experienced investor, and I even paid for recommendations. So I subscribed to a journal, and they published their recommendations, and their philosophy was also do not gamble, but invest in solid stocks. And I thought I made a clever choice buying Esprit, General Electric, BASF, for example, also big brands or big names of popular companies with highly regarded products. What can go wrong? And obviously a lot did. I'm not going into much all of these stocks. Or by the way, I still have some of these stocks today. I still own some of these. For example, I still own 110 pieces of 3M. I bought them for 45 euro, so it's about $50. And yeah, you see the power of patience. If you buy a solid company, if you invest in a solid company, it doesn't need to be Amazon, but just solid company like 3M. And we know that the performance of 3M in the last, I think, 2 years was really lackluster, really
Yeah.
absolutely bad performance. And still, the stock here, because I own this stock for such a long time already, I'm still don't know, something between 2 and 300%. I have capital gains and a lot of dividends I received during the last 11 or 12 years. And I keep this stock, I already mentioned somewhere else, because for me it's tax free and I don't want to abandon this status by selling it. Maybe it would have been clever to do it anyway, but I still keep the stock. I still have Unilever, for example, Philip Morris, I still own, Altria, I still own, and these were the better stocks. And most of the other stocks I did not mention so far were fails. And I chose two stocks I want to present you. And the first one is Nokia. And Nokia hit me really bad. I owned 960 stocks of Nokia, and I can show you when I bought them. I made my own, I have my own portfolio management here. So I made a lot of mistakes there. I made a lot of mistakes. In 2008, in August of 2008, the iPhone was not so new anymore. And Nokia already had problems with they were already losing market share. They were already on decline as a company. And by the dividend yield, or as a result of this decline, the stock price decreased, the dividend yield went up. And so this stock came on my radar because Nokia's reputation was still very good. And I remember the stock lured me with more than 3% dividend yield for the market leader of mobile phones. So I don't know if I already knew what's a smartphone these days, but for me, it was very attractive. So I made the first buy in August 2008. The stock still cost 18 euro. Then, nearly 2 months later, the stock dropped about 5 euro to 30 euro. I bought the next charge. And 1 month later, the stock price dropped even more, and I caught the falling knife second time. So, and then finally, 6 years, 6 years later, I sold the stock for about half the price, for about 5 euro. And I will show you how this looks like on dividend stocks cash. Or here we are on Aktienfinder, here on the German, sorry, but it's basically the same. And here you see Nokia, and let's select the stock, and then here we are in the valuation, and just look at the quote, the stock price. When I bought the stock, it was somewhere here is 2008. It was already declining, and that's, you see the stock price, it came from 26 euro. And let's have a look here. The stock price was 27 on its height in 2007. It already dropped when I bought the stock, and I thought it's a clever idea. You get a market leader with a discount and with high dividends, yeah. And then I bought the stock 2 other times because it was always dropping, the stock price. The dividend yield increased, and then 6 years later in 2014, somewhere in 2004, somewhere here, I sold the stock. Okay, and you see, I realized how much capital losses. I took a note, 8,200 euro. I realized that was my capital loss, and now it's always the question. Any one of us already faced such a situation, I'm sure, where you have really capital losses but still unrealized, and then you ask yourself the question, shall I realize, or is there still hope for a U-turn of the stock? So, and that's always a very hard decision to make. And I decided to sell the stock. And now, was it a clever decision to rescue the rest of the money I had invested? And I would say so, because if you look at the stock price today it's €4.20, and when I sold the stock, it was about 5.27. I even think I hit it exactly. Yes, exactly. I sold it for 5.27 euro. So I exactly sold it here. And if I kept the stock, I would have lost not only more money, but I would have lost years, 6 more years to invest in a better stock. And I think that's a very important lesson too. And let's go to the second stock, and that's what it is.
Before you move on, show the dividend history, the dividend turbo history for Nokia, going all the way back. Because
Here
wow,
you see it. Here's the complete dividend history, and you see that here it always paid between a little bit more than 2% back when things were still good from an economic point of view, when they were still the undisputed market leader. And then they faced this problem. It was exactly here, and the dividend was here back in 2008. As I said, I remember it was something like 3%, anything like here. And the end of August, it was 3%, 3.1%. And then it already jumped. You know, the capital losses, because all news of the company are bad. Capital losses, dividend yield goes up until 7%. And in the head of many people, they were still the market leader. And by pure market share for smartphones, it was still true. They were still the market leader. And then you got a market leader with a 7% dividend yield. How crazy world. That's an invitation for buying this stock, of course. So it was a fail in the first dividend cut, second dividend cut, and then complete annulation of any dividends. And so it was a very bad story. And somewhere here, I sold the stock, maybe somewhere when they didn't pay any dividends at all. So sad story, but at least I hope that I learned something from this. You still want to see some more of Nokia, Chad?
no, let's move on.
That really hurts. Okay. Eon is another big fail of mine. I lost 5,000 euros with Eon. Eon, also very popular company, at least in Germany. It's an utility stock. They produce energy, and it was also more or less high dividend stock. So if you look before the financial crisis, it paid between 3 and 4%, and it was rather solid dividend payer, increasing its dividends. And then came the financial crisis and came a special dividend. Well, let me give you the history. What did I do with this stock? So this was Nokia, and Eon is here. I don't know if you can read this because it's a little bit small, and it's parallel to Nokia. I also invested in this stock 3 times, and I also made the same mistake. Obviously, 2 times I caught the falling knife. So my first position. Let's go here to the valuation tab, and then let us show what I did here. Oh, just get rid of this. We don't need that. Okay, and then let's get a little bit back here and then here. And I bought the stock in 2008 in October. I bought the stock 3 times in October. This means I not only caught a falling knife 2 times.
You juggled it.
Yes, exactly. I was completely impatient because the stock price was falling from 30 euro to 27 to 24, 24.50. And also, hey, is it cool? The dividend yield goes up, goes up, goes up. That's a good occasion, a good chance to make even more profit, to get rich even faster. I don't remember what I was thinking, but the high dividend yield obviously attracted me. And then I sold the stock at the end of 2011. So I bought the stock in October 2008. So it was something here. And in 2011, at the end of 2011, I sold it. So it was something here. Okay. And then you see, I also realized my mistake. I realized the capital losses. Nokia, it took some more time. I realized my capital losses for Nokia 3 years later, but here I did it a little bit earlier. And then once again, was it a good decision or not? And today, Eon, after the spin-off from Uniper, I must say, but today only the stock cost 10 euro, and I sold it for 15 or 17 euros, I think. And the same here, basically, I was just too attracted by the dividends. And now I show you something else, I think, which is very attractive. I created this ranking, and it's just paying attention to stable cash flows and increasing it by 10%. Okay, that's a little bit, that's already a little bit demanding, but I wanted to show you that the ranking here, it shows you that some stocks are completely fails or don't shine from the ranking. So we have 3 stocks with a 0 ranking. It's BayWa, E.ON, and General Electric. I also own General Electric, by the way. I also owned Telefonica from Spain. And you see that these are all really they have a really lackluster performance. BASF, Aichon, and some others. And we only have a couple of stocks which are nice. Then I heard, for example, Unilever, 3M, Altria also shines with a very good ranking, and Voltas, Kluwer. So, and to me, basically, it's the same as it's for you, Chad, with the conclusion, my strategy was a wrong one. I focused too much on dividends. Exactly. You made the right thing already. Okay. I was focused too much on dividends, and I thought already that I was a clever investor because I was paying for a subscription. It was still sent to me 14 days, or it is 14 days on paper. And I thought already a clever strategy because I'm only investing in solid dividend stocks, but obviously that was not the case.
A lot of those are, let's say, one experience that we had is my wife paid for a subscription to an options newsletter where they promised to give us all of the details that we needed to make thousands of dollars on every trade. They absolutely promised it. And we tried it, and somehow the timing of when we did things meant that we lost every single penny that we put in. So, and I'm also remembering a lot of newsletters that I signed up for high dividends. And they would send me, emails every single day saying, hey, take a look at this one. It's got a 15% yield. And so that was part of my hunt. It was only when I started really looking at the criteria that I wanted to focus on that I started building a list that could actually do the right thing. that do what I wanted it to do. Now, we had one person ask for a link to the list, and I posted it. And also, I want to highlight this comment from Alex. This is why we're doing this channel more than anything else, is so that we can teach people the lessons that we learned, the hard lessons that we learned, and what lessons we can take. So those are our lessons, and it has been about half the time for a normal show. We've got 54 people watching. How about people post in the comments, what are some of your hardest lessons? What were some of your mistakes? And we can see what we can determine. And the standard question, if I had known, would I have done? And it's like, those are really hard lessons to learn, but they're important lessons to learn. So while we continue to go through some of these, post in the comments on any of the channels that we're broadcasting to, what were some of your biggest mistakes? Or alternatively, what were some of your biggest successes?
Fails are more interesting because there's more to learn, I think. And while people are thinking about their biggest fails until they post it, they're already, yeah, nice.
Wirecard.
It's already coming in. Wirecard, chat?
Yeah, I know the basics.
Okay, the story past the Atlantic, yeah. Okay, Wirecard is not a traditional dividend stock. It was a high growth stock. Maybe that's not a very good example, but TUI, for example, or Shell, or Vodafone, Tanker Factory, yeah. So great. By the way, I also own Tanker Factory, a small position till today. Yeah? What a shame. Let's look at some of these stocks. For example, Vodafone here. Vodafone. Let's take it out, and then I'm analyzing it. Or the question is always: was it avoidable, or was it a risky investment from the very beginning? Should you have known right from the start that a dividend cut is maybe not probable, but possible at least? And did Vodafone cut its dividend? Yes, it did. So let's change the layout of the chart. And if I just see that, so that the stock it has no solid earnings growth. Yeah, you see it here. It's very cyclical. Sometimes it works, sometimes it doesn't. So if you just look at that, and if you bought the stock somewhere here, I don't know, somewhere here or even there when they already posted losses, and what's about the free cash flow? Free cash flow is often still high, but don't know why. But if you look at the earnings, then you see that there's not much growth. If you also look at the stock price, let's have a look at the stock price. You see that there is not much growth either. So even that's the end of the dot-com bubble, or the burst of the dot-com bubble. But even if you start somewhere later till today, that's still about 19 years. And then you have capital losses over such a long run. And if you buy a stock with such a chart, then you should know that first, your overall yield to expect is not that high, and second, that dividends are probably not safe. Another stock. What did you? Anything else to say about Vodafone, Chad?
No, I don't know it that well.
Yeah, okay. It's not from the United States. I think I must search someone from Great Britain to make this live chat, so he can assist me better in stocks like Vodafone. So Südzucker. Although this one you I'm sure you don't know that.
Right.
It's second in the second row of Germany. Südzucker. Yeah, here it is. Ranking of 0 points. Ooh, that doesn't start. Doesn't start well. So let's have a look at that one. And Rob, Okay, it's also cyclical, obviously here. That's already nicer, but then here during the financial crisis, and then we have here already problems. We have here one dividend cut, two dividend cuts, three dividend cuts, the fourth dividend cut. So if you are somewhere here and you already know that the stock cut its dividend several times, then obviously it's not a safe investment. So just looking back into the dividend history is already also a quick indicator if the dividends are safe or not. It's not the best indicator, but it can be done very fast. And here the same, if you look at the stock price of Südzucker, then you see lackluster performance once again. So sometimes you win, sometimes you lose, but overall, you neither win nor lose. It's just a zero game. The stock looks like a zero game, and not such a good investment. Anything else? Do you know Gillette Science, Chad?
No. Which one is that?
No. I just
Gillette.
want Carnival, you know. Here, Carnival.
Carnival Cruise Lines, yes.
Carnival is another animal, huh? That was bad luck, I'd say, huh? Do you want to say something about Carnival?
Um
Or shall I do? Huh?
let's this is ouch.
This is out. Exactly, this is ouch. Okay, I will say.
Let's take a look at it. This is
Okay.
Carnival.
This is Carnival, and I really think two points about Carnival. First, it was always a cyclical stock. So in the tourism industry, if people don't have too much money, they don't spend a lot of money for vacation. And cruise lines are luxury, I think. I never was on a cruiser, but I think it is. It's not so cheap. And here you see the first dividend cut. Here you see it first. They really didn't pay any dividends at all in 2009 due to the financial crisis. So obviously the dividends are not super safe. But still during the financial crisis, so the free cash flow was already negative. So dividends weren't covered, but the reported earnings were still positive. So it didn't look too bad here during the financial crisis, at least compared to what happened now and what's happening now in the near future. And that was really bad luck. No one could see that the corona pandemic would hurt stocks like Carnival so badly. No one knew that.
So here is a question on that though, because if you look, let me switch things around a little bit. I'm going to share my screen. So here's Carnival, and here's the price, and it completely crashed down and has not recovered. But this is, let me see if I can find that. I'm not seeing, where did they, okay, I'm not sure where things went.
Just reload the stock. You change the layout. This
Okay.
is screen size. Just reload the stock. Click on the row once more. You didn't need to reload the complete screener, but okay.
Sorry about that.
Okay. No problem.
Let's go back to Carnival. And so one of the things that you need to keep in mind, there we go, is we don't invest for today, we invest for tomorrow. So I am seeing a lot of people ask the question, is Carnival a buy right now? Because the price has dropped down so much, are they going to keep coming up? Are they going to restore? Are they going to come back? And estimates say that they will. Okay, the experts who are watching the industry say that people might start going back onto cruises, sometime in in mid to late 2020, maybe 2021. So are they going to come back? So if we buy it right now, stock price of 14.22, maybe they could, if we're looking at the fair value, come up by quite a bit, but it's all up in the air.
Exactly.
And the other thing to notice is the dividend. Look at how I'm going to remove everything except for the dividend line, the blue line here. This is the dividend history. And here is that crash that, they paid a special dividend here and then dropped it back down. They'd been growing their dividends steady for 5 years and then dropped it. Basically completely. And they're expected to drop it even further down here and maybe raise it when people start going on cruises again and when they have profits again. But is this peak in January of 2018 to the beginning of the COVID crash here, is this an indication that maybe something else is going on? Maybe the company is not a great investment, not just because of COVID-19, but because the company itself is not well managed. Because the market knows.
Yeah, exactly. I'm just looking on the valuation because often the stock is already overvalued and then the stock price comes back to normal levels. Let me have a look here. So what I can see, I need to evaluate from the very beginning. That's, I think, a smart choice because we always had, if you look at the price earnings, we always had high fluctuations. We had price earnings range between about 10 and 30. So that's really extreme. So that's already the adjusted earnings. Huh? So it's not that we are speaking about outliers here, but they are all more or less useful, these price earnings. And if you get it's hard to wait here. I think the cash flow is a better indicator. It's not so easy to evaluate the stock. Okay, basically, I don't know what happened here, why the stock price dropped, because from point of view of both cash flows and earnings and dividends, anything seemed to went fine.
Yeah.
Till the Corona crash came. So if I wanted to dig a little bit deeper here, then we still have 2 other cruise lines, Norwegian Cruise Line and Royal Caribbean, if I remember well. And then I would look into these 2 stocks if they all also had this decline in stock price. So then, if yes, it was an industry-wide decline. So there was something with the industry going on. Like for tobacco, for example, it's the same. It's what we've seen for tobacco. Tobacco went out of fashion suddenly, literally from one day to the next. Tobacco was out of fashion, and maybe something similar happened here. Okay, so is there another one, or do you want to continue talking about the sunken ships here?
Let's see. What are some of the other? Let's see.
People are talking about you not knowing Gillette, but you can't know any stock.
Well, there are hundreds of thousands of stocks out there, and I did know the brand name, but I hadn't looked at it as an investor. So,
maybe dividend yield is too low for you, Chad.
I don't know about that. I mean, most of the ones that I'm investing in right now have a current yield of less than 0.5%. So let's see.
That comes close to me.
Okay. So Gilead is a manufacturer of one of the drugs that is helping to fight COVID-19. And that is a really good thing, and I'm glad that they're doing that. I hope they do well with that, but I'm looking 5, 10, 15 years out, and I'm really hoping that we are not dealing with COVID-19 for 5, 10, or 15 years. I don't want to say that the kind of gains that we'll get from Gillette are flash in the pan thanks to the COVID-19 crisis, but at the same time, I want to invest in stocks that have a history of growth, and a massive spike because of a very short-term, well, hopefully very short-term event is not really what I'm looking at. So,
I can accept that, Chad.
okay.
Okay, good.
What else
So
we got?
our audience don't have any stocks, any more stocks to where they failed. So our
Well,
audience are
Simon Property.
Oh, still one. I just wanted to say
Well,
our audience is the best one.
there's a bunch of them that, if you scroll up, we had a really fast, rapid fire response. So Simon Property Group was one.
Okay.
And that's a good REIT to look at because they just had some interesting news from Amazon. So we can look at Simon Property.
You or me?
Go for it.
I go. Simon. Yes, I remember. Tanga was also in the comments. Now I remember. What happened with Simon? Let's stay here.
So over the last couple weeks and months, Amazon has been negotiating with Simon to use some of their mall properties as staging grounds and fulfillment centers for the delivery services.
Okay.
So that is one of the reasons why you can see very close here such a massive spike. But you can see it dropped down because of COVID-19 and has not really recovered. What they're trying to do is get as much news as possible out to boost the stock price. But look at the estimates. Nobody knows if that is actually going to help their bottom line.
Exactly. So there are also brick and mortar retail like Realty Income or Tenga Factory, right?
Yes.
Yeah, just for the people who don't know. Yeah, okay. All of these REITs have massive problems right now.
And it's because people are not going out to shop. But if they're used as fulfillment centers for Amazon or other delivery services, people don't need to go there. The goods will go directly to their house. So it was interesting news.
Yeah, but yeah, okay, it's good news, but you need to go into detail if this really helps, because companies like Simon or Tenga, they have a lot of tenants mostly, and Amazon would be just one more, maybe a big tenant, but they can't compensate for all the other tenants who can't pay their rent anymore.
Right.
And
that's one of the reasons why they're doing this, is because some of their big tenants are like J.C. Penney and Sears and the big department stores that are closing their doors all across the country.
Exactly. And you see that the market also is still very skeptic about the stock. Stock price was as high, it was close to $200 US, $190 US, and now it's just about a third of what it was back at the end of 2018. Coming back to the question,
peak, because their oldest peak goes all the way back to 2016.
Exactly, I got it, 225 US. Wow. So that's a sad story. Huh? Close to 60% losses, including dividends, still close to 60% losses within 4 years. And bad luck for investors too, to come back to the question if it was avoidable. If you invested in such a stock, I think, okay, it's a cyclical stock. You can see it here, by the way. During the financial crisis, the stock price dropped from about $90 US to $30 US, 25 even. So that was a price drop comparable to this one. So it was a cyclical stock. They also cut their dividends here. So coming back to diversification, if you only buy REITs, then by brick and mortar REITs, retail REITs, then you don't have a diversified portfolio. But I think I can completely understand people buying high dividend yields like this one. They pay high dividend yield, between 3 and 4, close to 5%, because it's attractive. And what goes down must come up. It always have been so far like that. It's cyclical in nature, going down, going up, then dividend payments restart. But this really bad luck, really bad luck.
Hey, Torsten, here's another one. Let's switch over to BASF. Because what you just said, what goes down must come up. Well, the opposite is also true. What goes up may come down.
Yeah, exactly. BASF is one of these stocks I owned, I bought BASF in 2008. I was lucky. It's a very cyclical stock, and I bought this stock close to the bottom line here, really at the end of 2008 or in the beginning of 2009, somewhere here. And when I sold the stock, I realized capital gains, but I sold the stock somewhere, I think somewhere here, after it already dropped, the stock price already dropped. So let's have a look at the dividends. And you see that in the long run, they increase the dividends, Chad. So if you are looking for a solid German dividend paying stock, maybe BASF is for you. I'm just joking. You see that we had a dividend cut here, 2002. Let's add the earnings, the reported earnings, and then you see that's really bumpy. Maybe this runs a little bit smoother, not really. Okay, let's stay with this. And then you see that it's not very reliable. What's also interesting here, let's have a look at this. When the earnings go up, the stock price goes up. When the earnings go down, the stock price goes down. You see that? Except here something else happened. But basically, there's a very high correlation between the earnings and the stock price. And very cyclical in nature. That's no secret. So if there's even an unwritten rule, but I think it's out of fashion, it says that if the dividend yield for BASF is above 4%, then it's a buy. But I really don't give a damn about this, because a current dividend yield is 6.6%, so much higher than 4%, and it was higher, above 4% already back close to 2 years ago. It was already always higher like that. Okay, so very cyclical. BASF, management tries, gives the hardest to not to cut dividends, at least to keep dividends stable. You see it here, but that doesn't change the fact that BASF is very cyclical in nature. And you see it here from the capital gains. Current stock price is 50 euro. 50 euro was already the stock price back in 2007. So you can argue that in the long run, stock price still goes up, if you just start early enough back in 2000. But 13 years without any capital gains, for me, that's a no-go. So anything else do you want to add some of your wisdom to BASF?
Well, we've been focused. Not on this one. For one thing, it's not on my list because it's only available in the United States through an ADR, and those are problematic unless you're using the right infrastructure. But we've been focused a little bit on REITs, and so I thought I might highlight some of the good REITs. We had one comment here saying Digital Realty is one of his favorite, and so we can look at Digital Realty.
Yeah,
that is on my list, and it's in the 300s on TGI, which is a solid number. It's a solid stock. Growth is a little bit slow.
Yeah, but I completely agree. Digital Realty Trust is on my watch list too. And I also think that this is a long-term winner. Digital Realty Trust, because it really profits from a lot of data goes into the cloud. So they build and maintain data centers.
Yep.
It's just a little bit expensive, like most of the winner stocks are. They are mostly a little bit expensive today. You see here from the price earnings, adjusted
that's
price
overvalued.
earnings from 13, 12, long time, and then 14, and suddenly the jump starting here in 2016, 17, 20, 80, 20, 27 even, 27. And if you just try to get the fair value of the stock, and then you see here that the fair value of the stock is somewhere between 90, maybe 100 US dollar, based on the estimate of the current business year, but the stock price is 50% above. So this Digital Realty Trust is really aggressively priced. Here it was still fairly valued back in 2016 at the beginning, and then it already had the first spike, then it always come back close to the fair value, but then starting in 2019 till today, you see here these capital gains. And the Corona, Digital Realty Trust is immune to it was not immune to the Corona crash, but it just lost about 20 US dollar from 150. No, where's the Corona crash? Chat, help me. It was in March.
Yeah,
So
started
stock price
February, March.
dropped about from. I got a little bit confused because here you see it goes up and down and up and down and up and down, and normally it's the picture of the stock price there. You can see the Corona crash more easily than here, but this here, that was the Corona crash, I think, and the stock was not hit very hard, and it reached new highs today. So it's a little bit expensive right now. I'm waiting for the stock price to drop, but I'm already waiting for more than a year, for longer than a year, and it just never dropped as far as I wished to.
So the top ranked real estate investment trust on my list is American Tower, AMT.
Yeah, that's also a very cool one. Also on my wish list, American Tower. That I have a series. It's called Starter Depot, and we have we created a portfolio of 20 stocks, and we also chose one REIT, and and the candidates were Digital Realty Trust, American Tower, and Realty Income, and we opted for American Tower. Realty Income came into play because it's very solid, or not solid, a very popular, also solid, it was a solid, very popular REIT. But American Tower is the second one, exactly. And that's at the funds for operations here. And you see nice growth. It's a tower REIT.
Mm-hmm.
They lease towers, and they also profit from the data flowing through the air. It's getting more and more data flowing through the air.
Right.
And it's a very solid business. I can say it's a safe business. To me, it really looks like a safe business, and the market obviously also was aware of that, and because of that, the stock also seems to be aggressively valued right now. Price earnings reported between below 10 at the beginning, when the stock was not a REIT yet. It started paying dividends in 2012. And then the price earnings went up. It passed 20, and now it even passed 30. And if we look at the valuation of the stock, this one, then you see here fair values range very close, between 170 and 180 US dollar. Stock price is 250 US dollar. And you also see here that still back in the beginning of 2090, the stock was still fairly valued. And then we had this. Let's get rid of all the rest. And you see it a little bit better. And then you see this, capital gains of close to 50%, or
Nice.
overall yield close to 50%, annual yield of nearly 30%. So REITs don't need to be boring, neither down nor up. And here up has a potential, or the gains, Amazon-like capital gains, this stock here, this REIT. And we see that a REIT is not a REIT. First, Chad, you presented mortgage REITs. Then we have seen retail REITs. And now we have seen data center REIT, a tower REIT.
Let's finish off, because it is going on over an hour now. But I do want to finish off on the core of a lot of people's portfolios. Realty Income. Oh, it's one that you had on your list, and right now it's at 642 on my TGI list because the growth is so small. But I noticed something really interesting. If you look at all of the fair market values, so let's bring in the other fair market values, you can see that Realty Income right now is directly in the middle of all of the fair market values. So its stock price of whatever it is,
I can say you $61.
61. Looks to me, and looks based on those numbers, like it's right in the middle of the fair value right now. And Realty Income has been growing their dividend every single quarter, every single year for a very long time. How long? You don't.
Here, let me have a look.
25 years. Years of dividend increase, 25 years.
I didn't. I hit it.
Okay.
Here it is. 25 years. You are right, Chad.
Yep.
It's a dividend aristocrat.
Exactly. So if you're looking for a real estate investment trust that is at fair value and has been growing the whole time, they survived the COVID crash and they're doing just fine. I saw something that I saw a note come out in the news a couple of weeks ago that like 80% of their clients, of the companies that they are leasing to, have paid their rent on a regular basis, so they're doing fine. And I just wanted to highlight them because of the fair value numbers.
Yeah, that's exactly interesting point. I just want to add that we published both in German and in English analysis about Realty Income. Here it is. You see Realty Income. So feel free to read it. It's available both on Dividend Stocks Cash, that's the English version, and on Aktienfinder.net in German. I even made a video about this, I think, in German at least.
We had a comment about that, from Alex, saying that he's noticing that we're looking at the German site. It's like it's all the same data, it's all the same graphs, and there's
it was a mistake of mine basically because I was on this site. I should have normally, when we do this, we opt for the English version, but as Chet already said, it's basically the same. Yeah, sorry, guy.
No worries. All right, so it's been over an hour, and my family's getting hungry.
Okay, and I'm getting tired.
Yeah, it is 9 hours difference, so it's like 9 o'clock at night your time.
So thanks for watching and all your comments. You're a great audience. Hope you learned something from Chad and my mistakes. And we will continue streaming as we always do next week, next Sunday.
If anybody has ideas on what we could do a live stream about, please post them in the comments on any of the channels, and we'll take a look at them. We're doing this mostly for fun, but we thought this topic of learning the hard lessons of the past was important enough to highlight. But if you've got other topics that you'd like us to cover or stocks that you would like us to review, please feel free to post it in the comments.
Chad is doing this for fun. I do it for money.
Well, we're both doing it for money, but I'm doing it because I enjoy it.
No, it's really fun, and that's why I wanted to do a live stream, because always analyzing so hard, and I just want to talk with people sometimes.
Yeah,
like I do with you, and with you by your comments. You're a great audience. Thank
absolutely. All right, so we will see you next week, same time, 11 a.m. Pacific time, 8 p.m. German time. So we'll see you next week.
Bye-bye.